Hey guys, welcome back to Technical Analysis Thursday. Alright, we're going to be doing these videos every Thursday. We're going to be releasing another part. Right, so the first video in this series was the intro to supply and demand. We're going to go ahead and dive into part 2 today and start to, take the concepts that we learned in part 1 in the intro video, where we learned, a little bit of the theory behind it and why we set up the chart the way we did, and now we have a chart set up, a proper chart setup. And now we're going to start to go a little bit deeper into the details of how to use the setup. So the main thing for today is going to be discussing measured potential and something called risk versus reward, right? We just call it risk reward, and you'll see it, often you'll see it when it's typed out, it'll just be R-R. So that's your risk reward. The measured potential is going to be very crucial when trying to find an exit plan and determining what your risk reward is on the trade. So I think the very first thing we need to do before going any further is understanding this term right here, right? This is a crucial term right here. I almost want to go ahead and highlight it. It's so important. Let's go ahead and dive in so that we fully understand what measured potential is. Okay, let's go ahead and go over to the chart. Alright, when we're looking at a setup, and what I'm actually going to do is I'm going to pull up this chart here on LMND, right, because this is a stock that we talked about today and we've been talking about recently. So, fresh in our memories, and it's a perfect example. When we talk about the concept of supply and demand, what we're talking about is the theory that stocks trade within channels, right? And in order for them to continue to the upside or continue to the downside, they have to break through and reclaim the next level of supply or demand. Okay, so I'll give a quick little example on that concept, and then we'll go ahead and we'll start to understand how measured potential ties into supply and demand. Right, so, LMND, if we go back to May 13th, right, has been on an uptrend. Now, every time they hit supply, you'll see that they had a little bit of struggle here, right? So they bounced off of, this would be demand right here, right? We went ahead and we dipped down to here and we bounced, okay? That's our first level of demand. Now we're talking about supply, right? Because it's above this stock. So whenever the lines are like this right here is going to be supply because it's above. It's an area where sellers are sitting. We hit the supply. You see we struggled a little, bounced off it. We struggled a little at this supply, struggled a little at this supply, and you start to see, struggled a little bit here before breaking through. We struggled at this 200-day supply. Boom, broke through, tore through this. So now we have a clear channel and clear measure potential, right? When we're looking for a quality trade, we don't want to see all this junk, right? All these lines right here, because that's a big blob of supply and demand, right? That's an area where you think of it as the battle zone before the stock breaks out to the upside or downside. So these are areas we want to avoid. What we like is this nice clear gap, okay? And this is going to be our measured potential. So we knew once we reclaimed 94, right, and we closed above it on the daily chart, that our measured potential was going to be up to 110, right? Why 110? Because that's our next area of supply, right? If we zoom in on the chart, we've actually reclaimed every level of supply, and all that's left is it's actually our 100-day moving average, and it's 109. And if you zoom back on the chart here, you can actually see where we've actually fought this level in the past. So we know this is a significant level. We don't know how the stock is going to react once it gets to 110, 109.5, but we have a pretty good thesis that it should, not that it's going to get there, right? Because nothing is ever guaranteed in the stock market. All we can do is we can hypothesize based on the data we have. And the data right now would suggest that we have room to trade at least up to 109.5. So that's going to be our measured potential. The measured height of a continued bullish run on LMD, the potential that it looks like it could get to on a nice run is 109.5. And then real quick, I just want to go over one more chart just to kind of hammer in the concept, okay? So we go to A, B, and B, very similar, okay? We reclaimed these areas here. Let me go ahead and actually erase those lines there because I don't want to put it. This can get, this gets a little tricky dealing with all these lines of supply and demand. So any extra junk, I want to get rid of that. Okay, so once we reclaimed this 20-day moving average, our measured potential. Now the Bollinger Bands are more for, I prefer to use the Bollinger Bands for intraday. That's going to be your 60-minute time frame and your 5-minute time frame most of the time. For the daily chart, I'm not too worried about the Bollinger Bands. What I'm really worried about is that 50-day moving average, okay? So that's actually going to be our measured potential. So we actually had this trade mapped out this week, plus 145, 146 on A, B, and B. We wanted to go ahead and take it long. And the reason was because from 146, there was a measured potential upside to 157.5. So that's $11.50 move, which is very good. That's what we're looking for, right? So now we have a pretty good idea of measured potential, right? So now let's go ahead and let's really start to tie that into why that's important for us. Okay, so now when we're talking about risk reward, what we're going to be doing is we're going to be looking at delta, gamma, and theta to sort of come up with a rough thesis, right? And it's not going to be 100% accurate most of the time because we can't account for vega, which is the change based on how much IV changes. And just a side note, delta, gamma, theta, they're the Greeks of an option contract. If you're unfamiliar with them, just go ahead and Google delta, gamma, theta, and implied volatility. Those four are very important to understand, but they're fairly simple concepts. So if you go on Google, you could probably take you 15 minutes to get a pretty solid understanding of what those four things mean. So when we come up with this rough thesis of the, what kind of move we need to get a desirable move in our option contracts in order to profit off the trade. So we're looking for reward. We're looking at how much can we profit off a move to our measured potential versus how much are we paying for the contract. So when the contract value increases on our anticipated move, that's the reward that we're measuring. And then potential move to the downside is going to be risk. Now, risk is a little more tricky than reward for a couple of reasons. First is going to be how comfortable you are with taking losses, right? If you're someone that you like to use a hard stop loss of 30%, then you should probably just use that as your risk. If you're someone that's comfortable to holding something until it goes completely worthless, then use 100% as your risk. So if you pay $700, use a $700 risk, right? Understand how you trade. If you're not really too sure, I'm going to be dropping a video soon that kind of explains how I personally approach stop losses and a solid sort of, I wouldn't call it a theory, but more of a formula that I use on helping new traders develop a stop loss strategy. And I think that'll be pretty beneficial. So I'm going to be releasing, look for that within the next couple weeks. That video will be coming out. So now we have a pretty good understanding of risk reward, right? Like the concept of it, but we really need to dive into the details here. So I'm going to go ahead. Let's go ahead and open up Thinkorswim. Alright guys, so once we get into Thinkorswim, we have our options chain here, right? Now, because of the way that I set up the frame of the video, it's not going to fit everything within frame. I don't think you can see the delta over to the left, but I'll just go ahead and sort of call it out, right? So let's go ahead and let's stick with the example of LMND. So right now I have the options chain pulled up for contracts expiring tomorrow on LMND. So now we go back to this chart really quick, and let's just pull something up real quick. If we go to LMND, right? And we say that we think, let's just throw out a random guess because I don't want to analyze and take up too much time. So for the sake of argument, let's say that we think tomorrow it can get up to 98, right? So a $2 move, okay, right up to the 20-day moving average there. So we're going to be trading it tomorrow on 0 day till expiration. Now, if we go ahead and we buy at the money calls, which are going to cost, which is the 97 strike, because up here we can see that it's the bid ask is well, it's a little weird because of after hours, but it closed at 96.88. So we're going to go ahead and say 97 is at the money. Actually, guys, I don't really love this example because of the spread on that. Let me look for something with a tight spread, actually. Let me see, because A, B, and B is another good example, so I'm going to see how they're looking. That's a lot better. All right, let's use this example. Okay. Let's go with A, B, and B. Again, let's get rid of those lines. Let's say that we purchased these options at 144 with the measured potential. And again, this is just for sake of explaining the theory. I'm not saying take this trade or anything. So let's say we can expect a $3 move, right? Let's just use a nice round number. So our delta is $48 on these contracts here. At the money contracts, $48. So let's say our risk is $150 because we're paying $150. On a $3 move, our delta would give us $150 in profit, and gamma would give us about $30 in profit. So that's $180 in profit. Okay, so that means our reward on a move to our measured potential is going to be $180, and our risk is going to be $150. So that's 1.3 to 1 ratio, right? So that would just be how you would add it up really quick. Now, because that's 0 day till expiration, let's go ahead and let's take it a step further and let's look at a different expiration date. So let's say we go let's say we go 3 weeks out to June 25th calls, okay? So this is the June 25th options chain. Now for those same calls, our risk is going to be $650, but I'm going to put an asterisk there because we explained how risk reward can be a little tricky with if you use a stop loss. And now, because we're going 3 weeks out, let's go ahead and say that I don't want to dive into this yet. So just for the sake of explaining this, let's say we expect it to get up to 157, right? So we expect this stock to move to 157. So that would be a $12 move, okay? So the easiest way to figure that out, actually, a little bit of a cheat, is you can just go ahead and open up the options chain here to all. And you can say, okay, these contracts are at the money. So let's go ahead and let's move $12. Because if these contracts go $12 in the money, let's see how much a contract's worth that is already $12 in the money. And that's going to be, because it was at 144, that's going to be 132, 133. So this contract is going to be worth $1,400, right? So that means our potential reward minus our cost of $650, and we say $1,400 is how much it could be worth. Then what's quick math? $750, I believe. Yeah, $750 is going to be our potential reward, with a potential risk of $650. Or if you want to use a stop loss, you could probably use this 20-day moving average right here as your stop loss, which is 140.5. Okay, so let's say we use a $5 reversal as our stop loss. Then we can say how much are the 150 calls worth? About $450. And then we should probably consider theta, but it's only $15. So really our risk here is going to be about, I would say about $480, $650. So our risk is only about $170, and our reward on this trade is going to be about, what did we say, $750. So that's almost a 4-to-1 risk to reward ratio. So this is actually a great risk to reward ratio potential trade. Now again, guys, this was just for the sake of example. Don't take this trade. We can discuss this trade more in the next watch list video, but just for the sake of example. All right, but that's an just a quick example of how I personally calculate my potential trades that I go into when I'm looking at how much can I potentially make off this trade versus how much am I risking if this trade doesn't go according to plan. Because it's I would argue it's more important to have an exit strategy in place than it is a profit taking strategy, right? But both are very important, so don't favor one over the other. This risk reward strategy is going to help you sort of calculate that. So now let's sort of get into more of the nitty gritty of measured potential and risk reward. So as a general rule of thumb, I personally would stress to you that don't ever take a trade where the risk to reward ratio is 1-to-1 minimum. So we just talked about that Airbnb potential trade had a 4-to-1. The reward was 4 and the risk was 1. Okay, that's 400% difference. That's a great ratio. 1-to-1 would be like if our potential reward is $200 and our potential risk is $200. So it's not great, but if we believe in our theory, and we say we have about an 80% win rate, there's about an 80% chance this works out, then we can be comfortable with a 1-to-1, but it's not preferable. What's preferable is a 2-to-1 ratio. So $400 reward versus $200 risk, or to make it even simpler, $200 reward versus $100 risk. You want to look for at least a 2-to-1 risk to reward ratio. If the stock only has clear upside for a 20% increase in value, but the downside looks to give us 50%, so that's going the other way. That's like what is that? 2.5, a 1 to 2.5 ratio. That's awful. Don't even consider that trade. Very, very, very bad trade setup. Oops. The risk is way too high on this trade because even if it does work out, we're risking 50%. Okay, so let's say we paid $500, right? So our potential reward is $100, but our potential risk is $250. So that means that I'm risking $250 to make $100. Those are horrible odds, and I don't like that ratio at all. I'm never going to consider that trade. And now a very, very important note that I want to discuss with you guys is going to be that measured potential is not to be confused with a guaranteed move, right? We discussed this earlier in the video. Just because the measured potential on Airbnb is 157 does not mean that you should look at that chart and say it has to get to 157. 157 is a guarantee. That is completely opposite from the truth. Often you will find yourself taking profit well before maximum measured potential is hit. And that's not only is that okay, that's expected, right? We'll go ahead and dive into it with the rest of this slide. If there's a measured potential reward of 200%, so let's say we spend $100 on a contract and the potential reward that we calculate with our formula that we've developed here is $200. So we spend 100 to potentially make 200. That's a great ratio, but you shouldn't feel like you have to get 200%. We can feel pretty good about our odds of hitting 50% profit if our expected measured move is 200%, right? And 50% is still an amazing trade. Like 50% profit if you're doing that consistently, that's awesome. That's a great, great percentage gain. So if our measured potential is only 50%, then we're expecting perfection. We're expecting that we are going to get exactly a move to our measured potential in order to hit 50% profit. Now, if we look for a trade with that 200% or that 100% measured potential, now when we hit 50%, we feel pretty good about our odds of hitting 50% because we're only halfway to our measured potential, right? Versus needing a full move to our measured potential. So I really just want to emphasize that note there. That might be the most important part of this entire video. Do not confuse measured potential with a guaranteed move. Now the last part of this segment is going to be the differences between day trading and swing trading as far as measured potential goes. So by far the most important thing to keep in mind in this part of the video is going to be the time frame that you're using. If you're day trading, we need to understand average true range. And I should really edit that because yes, it's extremely important if you're day trading, but equally so if you're swing trading. So don't get that mistaken that it's just for day traders to listen to this. So what we're going to do is we're going to go over the indicator called average true range. If you have too many indicators and you don't have any more space to add a free indicator, if you're maxed out and it's asking you to upgrade to add more indicators, there's sort of a, I don't know what the word is, sort of like a do-it-yourself, requires a little more work, and it's not the pretty way to do it, but it gets the job done, right? There's a free way to do this that'll get the job done. So let's go ahead and let's look at that method. Okay, first and foremost, because this indicator is awesome, guys, you're going to go up here and you're going to just type in average true range, right? Boom, right there. Click it. It's going to pop up down here, and there you go. Now what I like to do, I know you guys can't see to the side, but I'll go ahead and call it out. When you hit the little down arrow over to the left and all your indicators pop down, you're going to want to click on settings for ATR, and then it comes at 14. I personally just like to use a 20-day length, and you can think of this like the moving average for your average true range. What it's doing is it's taking the average size of each candle over the past 20 days, adding them all up by 20, and then dividing them, or adding them all up and then dividing them by 20 to get your average range of a candle. So I like to use 20 just because there's 20 trading days in a month. So this looks at the average over the past month, which I just think this is the same. I use a 20-day length on my volume moving average as well. So I just like to stay consistent in looking at data over the past month. I feel like month is a nice combo of recency bias for day trading, but also you get a decent bit of the medium-term sentiment for swing trading as well. Right? So if we go ahead and we look at these candles here, all we're going to do is we're going to look at the lowest point and the highest point, and we're going to subtract the lowest point from the highest point. So the low point is about 143.5, and the high point is 151. So you go ahead and do that math, you're going to get 7.5. That means that in this daily candle right here, today, there was a $7.5 range between the high and low. There was a $7.5 range that Airbnb traded within today. And if we go down to our average true range indicator, that looks to be about the average, right? Our ATR says 7.47. What that means is that over the past 20 days, the average range of Airbnb on the daily is 7.47. Now, why is this important? Well, when we're looking for our measured potential, we want to say, okay, how long until we think it can get to 157? Well, 157 is $13 away, so about 2 days, right? And I say 2 days roughly because that's the minimum. It doesn't mean it's going to get there in 2 days. It may take 6 or 7 days, or it may never get there. Let's remember, this isn't a guarantee. This is just what is likely, but not 100% guarantee. And it looks like, if we calculate a $7 move, that's basically going to break us even for today. And then another $7 move will get us to our 157. So about two days, and on the safe side, we'll say maybe 3 or 4 days, just in case there's some smaller candles mixed in there. Like this day, it only had a $3.50 range, right? So the range is always changing. And you can see that in the indicator, that way back here, it used to have a $13 range, and now the range on these candles have gotten a lot smaller. So if we're looking for our measured potential to say like 176, then this is really important if we're swing trading. Well, how long until it can get there? Well, it's at 144, 176. That's a $32 difference. So you're looking at about 5 candles minimum. Now you should probably, for the sake of your expiration date, at least double or triple that, because you're going to have red days, you're going to have sideways movement, you're going to have smaller days, but the average looks to be about 5 days. So let's go ahead and double that and say 10 days. So let's say we need to go at least 2 weeks out. So 2 to 3 weeks out for a chance to catch a move to 175. So that's where we're going to get an idea of our expiration date. Now, that was for the swing traders. Now for the day traders, I'm going to go a completely different route using the same exact strategy. So let's say we're looking at the 60-minute time frame, right? And the average true range on a 60-minute candle, so now these are the 60-minute candles, is 1.85. So we can expect about a $2 move for every 60-minute candle. Well, if the first candle of the day has already moved $5, so let's say we're playing this uptrend. This is a perfect example when you're playing an uptrend, right? If this candle is already up $3 or $4 and the average range is only $2, that's an overextended candle, and we should wait for the next candle to form, especially if we're scalping. You know, it may be unwise to expect to jump into this trade and expect it to move $4 or $5, right? This is where we need to manage our expectations in a trade. Why would we jump into this trade and expect it to move $5 when historically these candles only move $2 to $3 at a time, right? Now, news might drop or something crazy may happen that puts in a $20 candle. Yes, it happens. But if we're looking at the data and the facts and the data tell us, no, we should only expect a $2 to $3 move for every 60-minute candle that forms, right? So then the next one forms. If it goes ahead and it breaks out here and it's only put in a 50-cent move, cool, we can expect maybe another $2 move. Now it looks like a good time to jump in. The reason why this is important, guys, is this kind of ties into why I, as a trader, as a day trader and someone who pretty much makes a living off of scalping, I really love bounces, because bounces pretty much let you catch the full average true range. When a stock puts in, let's take this for example, right? It pulls up to here, and now at this point in this candle, it's gone from 148 to 151. It's put in its $3 move. That's its average true range. That's actually more. So then I would rather buy it down here where there's not that great of a chance that it's going to keep dipping. Why? Because it's already hit its average true range. The odds of it putting in a $6 or $7 candle from a statistical standpoint would be somewhat of an anomaly, right? So I like my odds of buying it, and it can keep going up without extending its average true range that it trades within. So buying the dip, that's a big part of buying the dip that most people don't understand. They think that they're just buying the dip like they're buying it at a discount. There's actually a lot of statistical stuff that goes into this as well, and average true range is probably the biggest part of that. So that's going to wrap it up, guys. That's my whole spiel on measured potential, risk reward, and average true range. So the next video that we're going to be doing is going to be all about value, and it's going to tie into the last segment we did on this video, which was bounces. Extremely important. We're going to use all the concepts we learned in the past two videos, and we're going to tie it into this third video. And really the point of this series is going to be tying each video into the next so that it flows, so that you're taking the concepts you just learned and now you're applying them to the next concept you're learning, right? We want to have that nice flow where we're not jumping all over the place. So next video is going to be on finding value when trading with supply and demand. All right, with that said, if you guys have any questions, go ahead and drop a comment down below. You can reach out to me on Twitter. I'll put my Twitter handle in the description, or you can reach out to the Titan Twitter. And as always, you can jump in the Discord and message any one of us, and we'll get back to you. All right, take care, everybody.